Too often, investors trying to avoid market volatility turn to more exotic investment strategies that, in the end, wind up courting greater portfolio risk rather than less. A widely floated fund category these days is something known as liquid alts. To get a better understanding of what's meant by this term and what to make of these types of funds, we've reached out to Wes Crill, Dimensional's head of investment strategists. Thanks, Wes, for taking the time today to help educate us about these types of alternative funds.
Of course. Thanks for having me.
Let's start with a basic explanation of what's meant by liquid alt funds.
So as the name suggests, it's meant to replicate kind of the investment style that investors might be looking for from alternative assets, but in a liquid package. And what that means is it's mutual funds or ETFs that investors can access more easily. And the idea at the end of the day, or the premise behind many of these strategies, is to deliver a stream of returns that's uncorrelated with the broad equity and fixed income markets that in theory would serve as a diversifier for investors.
Okay, in a research piece on this issue, you've written that, quote, liquid alt investments claim they deliver higher potential returns and lower correlations to stocks and bonds, but have fallen short. What have you found?
So that's often the story we hear, and you've certainly seen the population of these grow over time. Since 2006, the number of liquid alternative strategies listed in the Morningstar database has grown from about 20-some to over 200. You certainly wouldn't be able to trace that to performance of these strategies. In fact, when you look at a weighted average of these funds in that category, their performance over that time period delivered an annualized return of about 1.7%. Just to put that in context, that's about half of what the global bond market did. And the volatility for these liquid alternative funds was a bit higher than bonds. So certainly not the performance level that might have been expected by investors.
How do they compare with stocks then? Or are these, I guess they parse themselves. Some try to outperform stocks, some try to outperform bonds, right?
And the performance obviously has lagged equities by even more. Just the US stock market alone over that time period returned over 9 percentage points per year. And I think that brings back an important aspect of this diversification story. The returns wouldn't be the end all be all at the end of the day if they did provide a reliable source of diversification for investors. But what we often see with these liquid alternative strategies is they're investing in the same assets that investors with a globally diversified stock and bond portfolio are already holding. In fact, a lot of the ways that they might seek to attain low correlation with stock and bond markets is to take long and short positions. But then, if someone is going short in a group of stocks that you're long elsewhere in your portfolio, it's questionable how much diversification benefit that really provides.
Yeah, you've also written that we believe investments belong in investors' asset allocation when they satisfy one of two roles: increasing expected return on managing risk, or going with fixed income investments that reduce return volatility. And I guess liquid alts just don't hold up on either count, correct?
Yeah, it's a pretty simple checklist for investors. Is it increasing your expected returns and helping you manage risk, or is it providing you something you don't have elsewhere in your portfolio, which is another kind of risk control? And so, just a cursory glance at the data shows that the return story hasn't held up. They've underperformed even fixed income. And then again, it's questionable whether they're expanding your opportunity set in a way that would help you manage risk beyond what you can already access through traditional equity and fixed income asset classes.
Okay, so what is the alternative?
Well, the alternative, and I think that's really what investors are always looking for anytime equity and fixed income strategies are disappointing. And certainly 2022 has given investors lots of reason to question what else they could be doing. But again, finding like the perfect investment out there without the benefit of hindsight is a very difficult challenge for investors, and it doesn't look like liquid alternatives have been a good way. I think at the end of the day, just broad diversification in your equities and fixed income continue to look like the most reliable way for investors to grow wealth and manage risk.
Okay. Thank you for your time today.
Yeah, thanks for having me.